Well, I'm going to take the second, what the Federal Reserve is doing in a second, and I'll deal with the first. It's all a matter of basics. Do you earn more than you spend? Okay, do you have a good income statement? And do you have a good balance sheet? Do you have one or two parents who care for you and give you the guidance and the values? Can I go to a good public school and have food and health care and come out with an environment of equal opportunity? That's all you need. That's all you need. Because if you do those things, you will have a civil population that will be productive, and that you will be financially capable, strong, and so you're going to do things better and better, and you'll be strong. So it comes down to those fundamentals. When I look at one country or another and I'm thinking, where do I want to invest? It's like I'm looking at those things. Do they have a problem with internal conflict, or is it orderly? Just those basics. Now, the question is, can we do those basics? Okay? So, how are we doing on those basics? You have measures to judge that. Yes, we can do it. And I think the most important thing is how we are with each other. Like, do we have a democracy in which we can come together and have a very strong bipartisan middle? Okay.
Raymond Thomas Dalio is an American billionaire investor and hedge fund manager who has served as co-chief investment officer of the world's largest hedge fund, Bridgewater Associates, since 1985. He founded Bridgewater in 1975 in New York. He is also the author of the New York Times bestseller Principles, Life and Work, where he lays down rules and framework he uses to navigate his life, and also goes over the management principles he used to build his multi-billion-dollar hedge fund, Bridgewater. In a recent interview, Ray Dalio describes the current global situation as initial negligence of the basics of civil prosperity, which is to make sure that there is a productive civil population who are financially capable and strong. This would lead to a better outcome, increased productivity, and a stronger economy. When governments worldwide fought COVID-19 by restricting travel and shuttering their economies in early 2020, markets went into a tailspin. Stocks dropped, the bond market cratered, and oil prices went negative. Central banks worldwide cut interest rates to zero and reassured citizens that they would do what it took to keep credit markets functioning properly. The Fed did its bit by slashing rates and restarting its quantitative easing (QE) program. The gambit worked with an unprecedented $2.2 trillion U.S. fiscal stimulus bill. Bond markets stabilized, stocks recovered, and household budgets were fortified through direct payments and expanded unemployment insurance. Throughout the latter part of 2020, Powell agitated for another massive congressional relief package. Congress passed a $900 billion relief package. Several months after that, Congress passed yet another relief bill, this time to the tune of $1.9 trillion. The federal government spent roughly $5 trillion to aid the national economy in response to COVID-19 lockdowns and restrictions. Over the same period, the Fed added more than $3 trillion to its balance sheet through long-term bond purchases. According to Ray Dalio, the Fed and the government gave an enormous amount of debt and credit and created a giant lurch forward, a bubble, and now they are putting on the brakes, and what this means is that they would be an equal giant lurch backwards. Welcome to Savvy Economists. We would take you straight into the video as Ray Dalio breaks down the imminent collapse we are facing right now, the role the Fed and government played in it, the catastrophic economic repercussion of the war in Ukraine, and interest hikes. Pay attention, and don't forget to hit the like button, subscribe, and turn on notifications.
The way the system works is, if you give a lot of money in credit and you make it cheap enough, they will spend it. Okay, but when you create debt, it's stimulative over the short run and depressing over the long run. Because when you have to pay it back, then you have to earn more than you spend to pay it back. So what do you do with that debt? Okay, if you make it tough to pay it back, then what happens is you have an economic downturn. If you make it easy, you print the money. And that's the cycle. So when we look at what the Fed has done, the Fed and the government together gave an enormous amount of debt and credit and created a lurch forward, a giant lurch forward, and created a bubble, okay? And now they're putting on the brakes. Okay, so now we're going to create a giant lurch backward, I think, because it's simple. The amount of, we talk about inflation. Inflation is a very simple thing. It's the amount of money that's spent, money and credit spent, divided by the quantity sold is the price. And so if you take that money away, then you can't get rid of inflation. The way you get rid of inflation is to get people to spend less. And that is what an economic downturn. So the cycle goes like that, and then when you get to the point where, let's say, the economic pain is greater than the inflation pain, then you see them do the opposite. So we're going through that particular cycle. So it's, I think, a delusion to believe that, okay, what they're going to do is deal with inflation and it'll all go away because they'll deal with inflation by doing that without realizing what that means in terms of what that means of buying power. Think about the supply demand of bonds. Just to give you, we have to sell debt. Well, the government is going to borrow, central government's going to borrow about 5% of GDP. So they have to sell bonds in that amount. The Federal Reserve is going to sell, or however run off the balance sheet, about 5% of GDP. That's 10% of GDP. Okay, who's going to buy the bonds? Who's going to buy that? Oh, now they don't want to buy the bonds. We've had, pension funds, others, they don't want to buy that bonds. Foreigners don't want to buy the bonds. So then the way that works is interest rates have got to go up to a level that constricts private credit demand. And when that happens, then there's less spending. That's the mechanics. So there's that trade-off, and I think we're going to be in an environment in which they're trying to navigate these two difficult. You don't want too much inflation, and you don't want too weak an economy, and so they're trying to navigate that, which will be probably something like the 70s. And that's all happening in the context of the political conflict, which is very important, and the international conflict, because the international conflict has bearing on things like inflations, supply lines, and all of that. That's great. They mean what they say. What they've done is they produced this giant lurch forward, and now, yes, they will raise interest rates to the point that there's enough economic pain and financial market pain to deal with them. The key, of course, is to try to get the balance as best as we can. I'm going to call it a beautiful deleveraging. You need a beautiful deleveraging. How do, in history, debts decline relative to incomes? So you could go back and see the mechanics of that. And the way that happens is a mix of some amount of restructuring debts, and that is a deflationary force, because one man's debts are another man's assets. And so some amount of restructuring is a deflationary force. You take buying power away from others. And then some form of debt monetization, and to get the stimulation, and they tried to get the middle ground. Because of the size of the issues we're dealing with, it's not something that we're used to in terms of its magnitude, I think. So, and then if we take the internal conflict factor, I think we have to look at all three because they play a role. And so it's traditionally, those three things are the perfect storm, right? They all affect each other. So if you have a bad economic situation, as you said, it affects one group of people and it hurts them, then you have an internal political conflict, right? The left and the right, the rich and the poor, and so on. And then that affects things, and vice versa. And then, of course, the external conflict, the cost of the external conflict. Like, for example, it's estimated that so far, the cost to the Ukraine war, to NATO, is something like $8 trillion. If you look at to rebuild, are we going to rebuild? Are they going to rebuild? They asked the NATO countries like they asked the European countries. Are you going to put in? Well, they're broke. I mean, they're going to put in. Then if you look at the cost of climate change, climate change is approximately $10 trillion a year. If you look at the cost of building infrastructure, if you look at the cost of all of those costs and you add up those costs, it's not like we're going to stop the spending. So you have to achieve that financial balance in some kind of a way. Right now, governments are like people, meaning when you spend, you think, the basic economics works the same. The only difference is they get to print money. So when you spend, you think, how much money do I have to spend? And then wherefore, what do I prioritize it on? I don't think we're going to have a sustainable interest rate that is going to be a real adequate interest rate. And so I would stay away from debt. Now, the interest rates went from ridiculously stupid interest rates, and they're coming into an area that still I think is too low, but it's not as ridiculous as it was before. They have to get really, so when you play with that game, if you want me to just do it, I'll just give you my thought real quick. Okay, what would be the equilibrium interest rate for the equilibrium inflation rate? Okay, we're going to have probably, I would estimate, we estimate maybe somewhere between a structural employment inflation rate, maybe in the vicinity of between 4 and 5%. In a highly uncertain environment, you can't even be sure of that, but let's say that. That means then what is the real bond yield? Okay, so you have to go to that. We now have about a 1.5% real bond yield. Do you still have a 1%? So you have to have the bond yield give you something. I don't know what that is, but that brings it above 4.5% to some other number. And you have to have relatively tight money, which means that you have a fairly flat yield curve. So I don't know whether that's 4.5% or the economy could not take an interest rate much higher than that before it's going to be negative. So those are the things that enter into my thinking in terms of what markets and what the portfolio would look like.
The Fed, government, war, politics, fiscal policies, interest rates, and monetary policies have all played a part in this giant lurch backwards, and there seemingly will be a hike in the interest rates, according to Ray Dalio, to be able to get us back to a safe landing as compared to where we are now. Increased hikes in interest rates would mean more severe hardship for poor people, a high cost of living and unavoidable poverty, and an increased crime rate. What do you think of the viewpoint of Ray Dalio regarding the global economic situation? Is it transparent enough? Does it make sense to you? Let us know what you think in the comment section below. Don't forget to hit the like button, subscribe, and turn on notifications.